The way you structure your business sale can cost you hundreds of thousands of dollars in taxes or save you that same amount. The sale price is only half of the equation. In this video, I will show you the key decisions that determine how much tax you pay when you sell your California business and the strategies that can help you keep more of what you built. Hi, I'm Pietro Canestrelli. I used to work as an IRS attorney in Washington, D.C., so I've seen firsthand how the IRS operates. If you're dealing with tax issues and need guidance from someone who understands the system, give me a call at 951-319-7674 for a free consultation. Now, let me walk you through how to structure a business sale to minimize your taxes. The first thing you need to understand is that how the deal is structured determines how much money you actually get to keep after taxes. Two business sales with the exact same purchase price can result in a very different after-tax outcome depending on how the deal is put together. One seller might keep significantly more money than another seller who sold for the same amount, simply because of how the transaction was structured. This matters even more in California because you are paying both federal taxes and state taxes on your gain. California has some of the highest tax rates in the country, so the stakes are significant. Here's something else to keep in mind. Buyers and sellers often have opposite tax interests. What is good for the buyer from a tax perspective is often bad for the seller and vice versa. This means deal structure becomes a negotiation point, just like the purchase price. The time to think about structure is before you sign the deal, not after. Once the documents are signed and the transaction closes, your options are extremely limited. Getting this wrong is expensive and usually irreversible. The first major structural decision is whether to sell your assets or sell the ownership interest in the business. In an asset sale, the buyer purchases the individual assets of the business. This includes things like equipment, inventory, customer list, intellectual property, and goodwill. The business entity itself stays with you. The buyer is essentially buying the pieces of the business, not the company itself. In a stock sale or a membership interest sale, if your business is an LLC, the buyer purchases your ownership interest in the business entity. This takes over the whole company, including everything inside it. The entity transfers to the new owner along with all his assets, contracts, and liabilities. For sellers, a stock sale is often more favorable from a tax perspective. When you sell stock or membership interest that you have held for more than 1 year, the gain is typically taxed as long-term capital gain. Long-term capital gains are taxed at lower rates than ordinary income at the federal level. In an asset sale, the tax treatment is more complicated. Some of the proceeds might be taxed as ordinary income, depending on what assets are being sold. If you have equipment that has been depreciated over years, selling the equipment can trigger depreciation recapture. Depreciation recapture is taxed at higher rates than capital gains. This can significantly increase your overall tax bill. For buyers, an asset sale is usually the preferred structure. When a buyer purchases assets, they get what is called a stepped-up basis in those assets. This means they can start depreciation in the assets based on what they paid, which gives them larger tax deductions going forward. In a stock sale, the buyer takes over the company with its existing tax basis, which is usually much lower. This conflict between what buyers want and what sellers want is one of the most important negotiation points in any business sale. Sometimes the buyer will pay a higher purchase price in exchange for getting an asset sale structure. Understanding this dynamic gives you leverage in negotiation. Once you decide on the type of sale, the next critical issue is how the purchase price gets divided among the different assets. In an asset sale, the total purchase price must be allocated among the different categories of assets being sold. This is called purchase price allocation. The allocation is not just an accounting exercise. It directly affects how much tax you pay. Different categories of assets are taxed at different rates. Inventory is taxed as ordinary income when sold. Accounts receivable are also taxed as ordinary income. Equipment may trigger depreciation recapture, which is taxed at rates higher than capital gains. Goodwill and going concern value are generally taxed at capital gain rates, which are lower. Goodwill represents the value of the business above and beyond its hard assets. It includes things like brand reputation, customer relationships, and the ability to generate future profits. The more of the purchase price that gets allocated to goodwill and other capital assets, the lower your overall tax bill. The more that gets allocated to inventory, receivables, and depreciated equipment, the higher your taxes. Buyers typically want more allocated to assets they can depreciate quickly because that gives them bigger tax deductions in the early years. Sellers typically want more allocated to goodwill and capital assets because those are taxed at lower rates. The allocation must be reasonable and defensible. The IRS requires both the buyer and the seller to report the same allocation on Form 8594. If the allocation does not make sense or does not reflect fair market values, it can be challenged. Negotiating a favorable purchase price allocation can save you a significant amount in taxes. This is one of the most overlooked aspects of business sale negotiations. Another strategy to reduce your immediate tax burden is spreading the payments over time through an installment sale. An installment sale is when the buyer pays you over a period of years instead of giving you all the money at once. With an installment sale, you generally only pay tax on the gain as you receive the payments. This spreads your tax liability over multiple years instead of creating one massive tax bill in the year of the sale. Spreading the income over several years can keep you in lower tax brackets. If you receive the entire sales price in 1 year, that large amount of income could push you into the highest federal and state tax brackets. By spreading it out, you may be able to stay in lower brackets and reduce your overall effective tax rate. Installment sales can also help you with cash flow. Instead of owing a huge tax bill before you have received all the money from the buyer, you can pay taxes as the payments come in. There are many rules and limitations to be aware of. Depreciation recapture is generally recognized in the year of sale, regardless of whether you actually receive the payments. So if your sale involves significant depreciation recapture, you may still have a substantial tax bill in year one. Installment sales also carry risk. If the buyer stops making payments, you may have a collection problem. You have already transferred the business, and now you're trying to collect money from someone who controls the assets you sold them. This strategy works best when you trust the buyer and are comfortable receiving payments over time. It's not the right choice for every situation. If you're selling a California business, you also need to understand how state taxes affect your sale. California taxes capital gains as ordinary income. Unlike the federal government, which taxes long-term capital gains at lower rates, California treats your gain as the same as regular income. The top California tax rate can be as high as 13.3%. When you combine federal taxes and California taxes, your total tax bill on a business sale can exceed 35 to 45% or more, depending on your income level. That is a significant portion of your sales proceeds going to the government. If you are considering relocating to a state with no income tax before selling your business, be very careful. California has strict rules about sourcing income from business sales. If the business operated in California and the goodwill was built in California, the state can still tax the gain even if you move before the sale. This is a complex area and the rules have caught many people by surprise. The timing of when you recognize income matters for California tax purposes. Proper planning before the sale can potentially reduce your California tax exposure, but this requires careful analysis of your specific situation. Working with a tax professional who understands both federal tax law and California tax law is essential when selling a California business. The combined impact of the federal and state taxes makes professional guidance especially valuable. If you are thinking about selling your California business, or you have already received an offer and want to understand the tax implications before you sign, call 951-319-7674 for a free consultation. I will help you understand how to structure the deal to minimize your tax liability and keep more of what you built. Now, if you run a nonprofit organization, you face a different set of tax challenges. Nonprofits can generate revenue, but the IRS has strict rules about what is allowed and what can put your tax-exempt status at risk. In my next video, I will explain exactly what types of revenue the IRS permits for nonprofits and how to avoid the traps that get organizations in trouble. Please watch it next.